Hello and welcome back to Forex Generals. So this video will not be a trading log video, but it will be a tip video where I give tips on trading for those of us that have already started trading. Now today's video will be about the randomness of the Forex market. Now the Forex market or price moves as a result of the interplay between the players in the market. Now this could be big players or small players, but the ones that really move the market are the big players like the banks. Now if you look at a chart, maybe a chart of Euro USD or GBP USD, you will notice that sometimes price is almost stagnant, and then at other times price moves in very huge swings, and then at other times it looks like it's going in one direction consistently. Now when you see price moving really quickly and really fast, it's usually because the big players have stepped in. It's usually because there is a transaction going on, or there are transactions going on between big institutions, between banks. Trades are being placed by the large players, by the big players. Now when nothing seems to be happening in the market, it's usually because they have stepped out. Now the big players don't get involved in the market all the time, which is why you would usually see the market go quiet from time to time. And interestingly, the market is quiet most of the time as compared to when it's not quiet. Now this is why the Forex market is random, because most of the time it's just the retail traders that are trading, because retail traders are literally always trading, because they're always trying to find a way to make money. However, the big players know when to step in and when not to step in, which is why, like I mentioned, the Forex market is largely random. Now what we do as retail traders is to, rather than being in the market all the time, what we try to do is let the big players play, let them leave their footprints, and then we, looking at their footprints, we then go in and trade based on their footprints. That's what we as retail traders try to do, because that's the only way one can be successful long term. We look at what the big players are doing, and then we jump on and try to make profit off of their move. Now, regardless of how skilled a trader is in doing this, in looking at their footprints, no trader will be able to make profit 100% of the time. Now that's impossible, to be able to make profit all the time. So when placing a trade, one should know that, and most of us know this, one should know that the trade could either go against you or it could go in your favor. Now, problem is, most of us know this, especially beginner traders. They know this before placing a trade. They know, yes, this trade can go against me, this trade can go in my favor. However, after they've placed the trade, after they've clicked that button, the mindset changes, automatically changes. From that point on, they're expecting a profit. Interestingly, they're expecting a profit, such that when the trade goes against them, they get upset. But if you really consider this, you realize that behavior is not rational, even though most of us do it, or used to do it when we just started. That behavior is not rational, because you know that when you're placing that trade could go either left or right. It could go either up or down. But after you've placed the trade, you suddenly lose sight of the fact that it could go either way, and you expect it to go in a certain way, which is in your favor, which is why a lot of traders lose their accounts, which is why a lot of traders do not succeed in Forex, because they expect that trade to go in their favor. It doesn't go in their favor, and then when they lose that money, they put in more money to try and make back that money they've lost. But at this point, they're being irrational, because the trades that they are placing are not trades that are based on their strategy. However, if they were able to go into the trade knowing that the Forex market is largely random, then when the market turns against them and results in a loss, they would understand that yes, the Forex market is largely random, so I should expect random results sometimes. I should expect random results sometimes. If we have that at the back of our minds all the time, then the results of trades will not have any impact on our emotions, and our trading will be way more consistent, because we know that the market is random most of the time. So when we place a trade, even after we've done our analysis, we need to know it is random. So something random could happen, because it's the market. It's the Forex market. So hopefully the tip for today should be that when we are placing trades, let's always remember that it could go either way. It could go either way, no matter how schooled you are, no matter how much experience you have in Forex trading. The next trade, the current trade, can go either way. Always remember that until that trade is closed and it has given a profit or it's given a loss, that trade that's running, or that trade that you're about to place, can go either way, because the Forex market is largely random. What we do as Forex traders is to try and find patterns in this randomness and trade these patterns. However, because the Forex market is largely random, trades will not go our way all the time. And that's it for today. Like I usually say, if you liked the video, like, share, subscribe, and comment. Let me know what you think about the video. Until next time, stay safe in the markets.